Good evening, everyone, and welcome to the webinar hosted by DSIJ Investment Journal. Good evening, friends. This is Karan Bhojwani, Executive Editor and VP at DIU Research at DSIJ Wealth Advisory Private Limited, formerly known as Dalal Street Investment Journal, DSIJ Private Limited. So, today's webinar is going to be an interesting one as we are going to talk about a topic or an indicator which is not widely discussed in the market. However, we have seen many of the market veterans in the Western world have been following this indicator very widely. And to be honest, I have been following this indicator in my personal setups to analyze market and to understand where are the turning points and where the market has extended or stretched from the current moving averages. So this indicator help us to understand how far the price has stretched from a current point of time or even price. So this is a very interesting indicator, and we will discuss the core idea behind this indicator. So now coming to topic, the topic name is understanding disparity index. So I have been following the disparity index for last multiple years, and in this webinar, I will be sharing my insights and reading about this indicator, which I have understood by using this indicator throughout the years. So before beginning the presentation, this is some standard disclaimer from DSIJ Wealth Advisory Private Limited, formerly known as DSIJ Private Limited. Research analyst and investment advisor is regulated by SEBI, which is Securities and Exchange Board of India. Investment in securities market is subjected to market risks. Read all the documents carefully before investing. The securities quoted in this presentation are for illustration purposes only and are not recommendatory and should not be considered as a recommendations. Registration granted by SEBI, enlistment with BSc and certificate from NISM is no way guarantee performance of the intermediary or provide any assurance of returns to investor. So this is a standard disclaimer from our part so that we are clear before that whatever illustration we have taken, it is just for an educational purpose. It will help you to understand how the indicator behaves and how one should take it with along with the other indicators they are applying in the market. So moving ahead, so we have divided this webinar in three different parts. So in the initial part of the webinar, we will be understanding the concept of disparity index, the core concept of disparity index. What does disparity index means? How to plot a disparity index and how to understand the values of disparity index and how to identify the turning points. Secondly, we will move on to a very interesting segment, difference between RSI and disparity index. RSI is a very widely followed indicator in the markets, which is known as relative strength index. We will compare RSI with disparity index and see what are the shortcomings and advantages of disparity index against RSI. And lastly, and the most important part of this webinar is going to be the historical context. So as I said you earlier, I have been following disparity index in my market analysis studies. So I will show you how to utilize it and how it can give you a useful signals when the price are too extended and when the price are too stretched away from a particular moving average. I will give you understanding how to plot it and what are the key levels to watch out. So this historical context will give you a complete picture or a complete insight into how should one look at the disparity index. So moving ahead, we will understand disparity index starting from the core concept of disparity index. So I'm moving ahead to a different slide. So as we all know, prices always does not move in a straight line. Most of the times we see that prices move up, then they pauses and take a relief counter trend move, or maybe also known as a pullback in a technical term. During an uptrend, we see that after the initial rally, stock prices pull back, take support and go on to make a higher high. And again, it pauses the uptrend and sees a counter trend move and it retraces, which is also known as pullback, and then again moves higher from that retracement after the counter trend move. So basically, price is moving in a wave kind of pattern. If you check over here in the presentation, in this slide, after a good up move, we see that the prices are moving lower, which is a counter trend move. However, they are not significantly moving lower. They pause it at a certain point of time in the chart and then move higher, forming a higher high. Then again, it retraces back in the form of pullback, which is a counter trend move. And again, it moves higher from that level. So this complete cycle of the market is known as the uptrend, where the stock prices or index prices is forming higher high and higher low. So you see after this high, we see this high, which is higher than this high, and the low, if we compare this low to the previous low, this is a higher low. So this formation in the technical terms or technical parlance is known as a clear uptrend, where the prices are moving higher high and higher low. During this clear uptrend also, what we have seen, there are period of pullbacks. As mentioned earlier, prices not always move in a straight line up. There are some cases where we have seen euphoric move, where prices move straight up in the upline. However, the normal uptrend definition suggests that prices moves higher, forming higher and higher low and higher high. So this is the definition, and within this higher high formation, higher high and higher low formation, we see certain period of pullbacks. So now, as a trader, what is important to understand when these pullbacks are going to come, or anticipate or find out a high probability point where we expect a pullback will be coming after a recent rally in the uptrend. Similarly, during a downtrend, what we see, prices does not go straight line in the downtrend, down way. It moves in the similar reverse pattern, which is vice versa of higher high to higher low. It forms lower highs and lower lows. So in downtrend also, we see counter trend moves, where price initially moves down lower sharply, then again sees a minor pullback, then again goes on to make a fresh low as compared to the earlier low. This is known as downtrend, where the prices are making lower high and lower low. So by this, we are trying to understand the core concept of price is that most of the times prices move up, but it sees pullback in an uptrend. Meanwhile, when the prices move down, yes, it sees a counter move where the prices are moving against the trend, where we see a counter trend up move. So this is clear, where we have understand uptrend and downtrend. Now within this uptrend and downtrend, we need to identify crucial points from where we are likely to see a counter trend. Why it is important to know from where we are likely to see counter trend is because sometimes we get trapped into a following a breakout trap. As a trader, what we usually do, we follow the trend, but we don't know at which point the trend is too extended or stretched. That's the reason later on we have compared disparity index with RSI, because many of us, what we do, we follow RSI index, relative strength index, to understand where the securities have entered an overbought or oversold region. But we have all known that overbought condition in RSI can remain in overbought for a longer period of time, correct? So that's the reason we are today understanding disparity index. So whenever a breakout occurs, or we see a formation of a clear-cut continuation pattern in an uptrend, what is important is to understand at what price we are entering. Breakout is one thing, and secondly, important thing is at which price we are entering. Like here we have mentioned, an entry in a strong uptrend can still become a poor entry if the price is too stretched or seen a swift run up in a short period of time. The stock may reverse from higher levels, or worse, fail to attract follow-up buying after the breakout. So this is very important point as a trader we need to understand, or as a market participant to understand. Even if the stock is in an uptrend, like we see in the last slide, every stock uptrend has follow a rhythmic pattern where the stock up move has seen a counter move, which is a pullback. So what happens if we enter a stock at a higher price and the prices are now about to see a counter trend move against the uptrend, which is a pullback, or moves higher, minorly higher, and then again sees a minor downtrend within an uptrend cycle. So that's why having a proper entry in an uptrend, or having a proper breakout entry in a strong uptrend, is important. That is why this indicator which we are talking today, disparity index, is vital. So the important point one should ask is, before chasing any stock, is, has the price already moved too far from its average, or it is too far stretched, so that if we enter at the current level, we will be going to only see a retracement, or maybe we don't see a follow-up buying immediately. So this is where the disparity index comes into the picture. It helps to identify as a crucial turning points. It helps market participant to understand which breakouts can be probably high breakout points, or a good reliable breakout point, or a point where the stock is still in a very good zone to enter, and it is likely to see an continuation of up move from here on, rather than price retracing back or seeing a counter move. So I hope the core concept of disparity index, why it is used, has been addressed in this slide. Now we will move on to understand what is disparity index. The disparity index, also called as disparity ratios. So it is also known as disparity ratio. Now what does disparity index helps us to understand? It compares the latest price, which is the current market price of a stock or underlying asset, as compared to a moving average. The moving average can be any moving average you have assigned to the chart. It can be a 20 weekly moving average. It can be a 200-day moving average. It can be a 50 DMA, which is daily moving average. It can be any kind of moving average which you have assigned. So that's the reason right at the beginning, I said the historical context is very important when you apply this disparity index. So we will understand in the later segment of this webinar which moving average is more reliable to Nifty index when we will see the chart. So basically, disparity index tells us how far the price is away from the moving average which you have assigned. So the formula of disparity index is simple: latest close, which is can be a current market price, can be a daily closing price, minus moving average value, divided by moving average value into 100. You will get this in a percentage form. Now, let's say, suppose for an example, when I say Nifty index has a disparity value of 5% as compared to its 20-week moving average. So what does it mean? It simply implies that the current price of Nifty is 5% above the 20 weeks moving average. So when we say disparity index value is 5% of 20 weeks of Nifty index, we try to say that the latest close is 5% above the 20-week moving average. Similarly, when we say 200-day disparity index value is 7%, here we mean that the current close is 77% above the 200-day moving average. Just to give you an example, let's say the current market price of a stock is around about 2,000 rupees. And the moving average stands at near about 1,500. So the gap between 1,500 to 2,000 is 500 rupees. So we will put the values in this. So latest close is 2,000. Moving average value is 1,500. Divide by again the moving average value, which is near about 1,500 again, multiplied by 100. So we will get a percentage value, which would be around 30%. So this would be stating us that the current stock, the stock which we are tracking is currently 30% above its defined moving average. So that would be a disparity value. So it helps us to understand how far the price has been stretched from a current moving average which we have applied to a stock. So while moving average is important over here, we have seen that moving average is one of the widely followed by market participants, which is why they are very helpful for the reference point. So I hope this concept is clear. And to just give you an illustration, I have got this rubber band also. So let us say my finger is a moving average and the price starts to move about this, my finger. And the more it stretches away from the finger, far apart from my finger, that means the prices are moving higher as compared to the moving average, and the value of disparity index will keep on rising. So the more the price moves from the moving average, the higher would be the disparity index value in the positive term. Meaning, on the other side, if the price is moving lower, so my finger again is an illustration of a moving average, reference point of a moving average. And let's say it starts going down, 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 down. The far it stretches from the moving average, which is my finger, the value would keep on rising in the negative terms. Why? Because negative, because it is below the reference point, which is the moving average. So moving ahead, we will move to a different slide. How to read disparity index? I have given you some understanding about how to read disparity index, but again, here we will revisit the concept again, how to read this. When we say disparity index value is 0, it means the current market price or the closing price of an index or a stock is equal to its moving average. Moving average can be anything. It can be 200, 20, 50, 100. Any moving average you wish to assign it based on the historical context, which you find is reliable, and you see that the readings are valuable when you analyze the chart of a particular underlying security. So value is considered to be 0 when the price and moving average are equal. Disparity index below 0. So when the prices move below the moving average, it starts to go in the negative value. Like I mentioned, the farther the price moves away from the moving average, the disparity index will keep on increasing its value in the negative side. For an example, over here we have seen, let's say a price moves 5% below its moving average value. it will be said as a -5% disparity index value of 20-day DMA of a current stock. Similarly, above zero means when the disparity line is when the current market price is higher than the moving average, then it will be above zero. So I hope the reading of disparity index is clear to you. Zero is disparity is price value of disparity index is zero when the price is equal to moving average. Below zero when the price is less than the moving average. Similarly, above zero is when the price is greater than the moving average. So these are the basic readings of the disparity index. Moving ahead, we will understand the difference between disparity index and RSI. Again, why we have used RSI? RSI is most widely used indicator followed by market participant to understand overbought and oversold region. However, we will try to understand the difference between the two. Now, what it measures? RSI measures the speed and magnitude of recent price moves. So RSI formula is articulated in such a manner that it helps us understand the speed or the magnitude of the price moves in the past 14 days. Why I'm saying 14 days? Because default value is 14 period. Some might change it to 8, 9, depending upon their reference level. But usually the widely followed is 14 period. So it helps us to understand the magnitude of price movement or the speed of the price move seen in the last 14 period or 14 days. Meanwhile, disparity index help us to understand how far the stock price is currently from its moving average. So it helps us to understand the distance of current market price from its reference moving average. Scale. RSI moves between 0 to 100. It cannot go beyond 100 level and it cannot go beyond 0 because the formula is again formulated in such a manner it cannot go beyond 100. It cannot go below 0. But meanwhile, disparity index is open-ended because it has a reference point. Reference points is a moving average, how far the prices have moved from its moving average. Similarly, the reflection would be seen in the disparity index. If it has moved 10% from its moving average, which we have assigned to the stock, it will move, say that the disparity index value is 10%. Meanwhile, it has fallen 8% from below the moving average, it will show as a -8% disparity index value. Widely used level, again, common levels, RSI is very much defined. In most of the books you will read that, or in the majority of the books we have read that RSI is considered to be overbought when it is about level of 70. Meanwhile, oversold below 30. And disparity common, again, levels are positive and negative. Positive up if the index or the underlying value is above the moving average, it will show a positive value. Meanwhile, if the price is below the moving average, it will show the negative value. Best use. RSI can be best used as a momentum and to understand overbought or oversold reading. Meanwhile, disparity index can be best used as a mean reversion, trend extension, and to understand how far the price have stretched from a particular moving average. Understanding. RSI again, nowadays we can simply plot with a click. The values can be easily seen, but during the initial phase, people used to use the formula and get the value over there. So nowadays, again, it's not so hardcore to do this thing, but definitely it is a formula driven, and slightly change in the formula for the period, look back period can differ the result. Meanwhile, disparity index can be just viewed as a simple glance and can be understand how far price have been moved higher or below the moving average. Again, at the sign of caution, the problem area, RSI can stay overbought or oversold for a long period of time in trending markets. In uptrend, we can see a stock price rising continuously, and despite the prices have risen so far so sharply, again RSI can be overbought and can stay in the overbought region for a long period of time. And like we have seen that many of people try to understand if the RSI is in the overbought zone, the prices might see a reversal from there, but that's not the truth. Prices can see momentum slowing down, but it cannot see a direct reversal just on the base of overbought reading. That's why we have written in trending markets, RSI can stay in overbought or oversold region for a long period of time. Now coming back to this thing now, disparity index again, it needs a historical context because there is no universal extreme level like we have seen during the COVID period. How sharply the market fell within a short period of time. And again, it bounced back so sharply within a short period of time. So again, extremes are not considered in disparity index. It needs an historical context to understand. And again, like a bell curve, we see that most of the times the prices usually moves in this band, but during the event like the black swan event, prices tend to move so extremely in nature that it is hard to predict. So again, I'm saying disparity index is not a foolproof index or an indicator to use, but it helps us to understand or find out the high probability turning point. I hope the this concept of core concept of disparity index is clear with you all, and we have seen the comparison between RSI and disparity index. Now we will head towards the third segment of this webinar, which is understanding the historical context and what value to use. So we will be using Nifty index chart. Again, it's an index, so it will be helpful for each and everyone to understand. And we will see how historically it has moved in a particular band and how helpful disparity index has been to understand the pullback or maybe a mean revision period with the help of disparity index. So I will be moving ahead to a chart segment. I hope everyone is able to see the trading view platform. So this is the daily chart of Nifty. So daily chart means every single bar represents a day's action, complete action of the day. The chart is visible to everyone. Okay. So the answer is yes. So this is the daily chart of again Nifty index, which represents the daily move of the Nifty. Each bar represents the daily move of Nifty. So now what we have to do is just simply search in indicator disparity index and just click on it. It will be getting plotted automatically and you will be getting such kind of line over here. However, if you see here, the close value is 14. We need to change it to 20 because as per my experience, what I have seen over the years, the value of 20 is of profound use and it helps us to identify the turning points when it reaches to a particular extreme level. Now, if you notice over here, so this is the band of almost 5 to 6%. So over yes, you can see that Nifty has reached near about 5% disparity index value, 4.94 over here. And you can see the prices have come down from the higher levels. From here, where the disparity index was almost value was 5, the prices have come down. Again, the reference value of near about 5 to 6 is very important historically context. Now, again, over here, you can see the prices of the index reached 5 level over here, and it has come down, not meaningfully, but it has retraced back to a certain peak point. However, given that this was a great uptrend, that's the reason we did not see a meaningful revert to the mean. However, it mildly saw the revision or retreat from the higher levels. Again, over here, the price value of disparity index 5.6, and we can see the prices coming down from here. Over here, again 6, and this time the prices have come down sharply. Over here, also 6 prices have come down, not sharply, but meaningfully, seeing retreat from the higher level. So if you simply keep the zone of 5 to 6 highlighted in this region or disparity index. So this is 6.6, this is 6, this is round about 5, this is 5, 4.5, 4.5, and over here 4, 5. So you will see that whenever the disparity index value hits the level of 4.5 to 6.5 range, it tends to retreat. Now, again, the question over here, now depending on what kind of scenario of the market is, the retreat depends upon that thing. However, it just informs you from here, the price are stretched completely. If you are trying to play a breakout over here, okay, there is a high probability that it might not move straight away in the expected direction, despite the trend being an uptrend. It might retreat from the higher levels, or it can see a slowdown in the momentum. Like we saw in a couple of cases, where the retreat was not sharp enough, but it did retreat. So basically, the breakout which you were trying to play would not have been materialized immediately. So these extreme zones help us to identify a point where the index has sharply risen or stretched from its 20-day moving average. So over here, we have changed the period to 20 period, and it is showing us how much the prices have moved of an index from the 20 moving average. So whenever the values over here reaches 4.5 to 6.5, it is usually considered, historically, we have seen that the prices tend to retreat. So in case if we are trying to pick a breakout where the disparity index value is over 4.5 or over 5, so basically that means we are playing a breakout at a stretch price. It might see a soft retreat from the higher levels or soft pullback from higher levels. At that point of time, it might give us a good opportunity if we are planning to with a good risk reward. But if we are planning to play the momentum in such a manner where the prices have already risen so much from its moving average, 20-day DNN, and important thing is 20-day moving average shifts its value depending upon the closing prices. It is dynamic in nature. It is not static. So it moves along with the market. It's move its structure along with the market. If the markets are falling sharply, it will move lower. The curvature of the moving average will be slanting downwards. So on the upside, 4.5 to 6.5 region. Similarly, on the downside, if you mark 4 to 6.5 value, it gives you an idea the prices are overstretched on the downside. If you can see this zone, the value was near 6.5 or 7. Again, over here, it was almost 4.15, but it did not go beyond 4.5, but near about 4. Over here, again, we have repetitively seen from where the prices have risen, and the value here was again 5.53. So this values of 4.5 to 6.5 in historical context, we have taken this value and we have seen the price moving within this band. Okay, the disparity index is moving within the band, and every time the disparity index reaches at an extreme, it at the higher point, if it reaches an extreme, the prices tend to retreat from the higher levels. And on the downside, if it reaches to the extreme level, it tries to see a pullback from that level. So it helps us to understand from where the prices are likely to see turn from the downside or from the upside to the downside, or maybe a pull off in the prices. Now, one interesting example over here, we can see that in the recent months, I will plot an RSI also over there, which is relative strength index. So as we understood from that comparison and values, RSI above 70 gives us an overbought indication. So during this period, during the month of April, what we can see, disparity index touched almost 4.8 to 4.9 level. Meanwhile, RSI was near about 60. It was not in overbought. But what we saw, because disparity index usually follows the range of 4.5 to 6.5 on the upside, and similarly minus 4.5 to 6.5 on the downside. Yeah, despite RSI not being in overbought zone, here we got a signal that prices have moved too far away or too stretched from its moving average of 20-day. So that's why we can see that this gave a good signal of retreat from the higher levels. Over here, you can see the prices move in a downward direction from the higher levels. So over here, you can see over here, moved in this direction. Similarly, here it entered the overstretch zone and it started to pull off from here. Meanwhile, RSI did not hit the level of 70, which is an overbought level. So the region of 4.5 and 6.5 is in the historical context is very useful for Nifty index on a daily chart. However, different stocks tend to follow different values of disparity index. It is not necessary the Reliance industry stock would follow a similar nature. That's why during complete presentation, we talked about historical context. We need to see in history what has happened, where are the most turning points, and we need to plot that zone as a turning turn, and we will get a value or a range, defined range value from where the prices are likely to retreat or move higher. So in this Nifty daily chart, we have used 20 DME, which is very good, and you can see how it is giving the result. Okay. So this was most of the things or my experience with respect to disparity index. If you have any questions, you may ask with respect to disparity index. I would be happy to answer all your questions. So there is one question, can I use it for an intraday 1-minute chart? No, this can be used as a 20-day moving average on a daily chart itself. On one day, it might not be helpful. So anyone has any question or any feedback, did you guys learn something new today? Did it sound interesting? Would you like to try new trading system or trading while you are doing analysis? Yes, this is useful for swing trading. The whole idea is for swing trading purpose to find an extreme point and to understand from here The prices have stretched far away from the moving average, and they are likely to retreat from the higher level or see a retracement from the higher level. Should we use disparity index only with respect to index, or yes, you can use it on a stocks as well. But again, like I said, you need to find out the historical context, and I would suggest only look for top 15 to 20 liquid stocks of Nifty 50 index. That will give you a better result. For index, the parameters I have suggested are fine-tuned and historically proven, highly probability levels over here. Thank you. Someone has said best indicator. Thank you very much. So guys, if you want to follow or read about such content every now and then, so you can visit our website, which is inside.dsij.in, where we post a lot of knowledge articles and plus what is happening in the market. And you can see that a lot of news, result analysis, everything is available at a single website. And also, if you are interested in investing or trading, there are multiple products, services, and offerings. In investor services, we have large rhino catering to the large caps, mid bridge to mid cap stocks, tiny treasure again to a small cap companies. So there are wide variety of products to choose from. Among the popular is value pick, multi bagger, and penny pick. So you can choose the product based on your risk appetite and the capital you have. And among trader services, we have Pop Stocks as an offering. Pop Stocks is an intraday product, an intraday cash segment product. Pop BTST, again a popular product. BTST is buy today, sell tomorrow. One of the best-selling products. Pop option. People who are dedicatedly trading into options, stock options, can look into this product. TAS is in technical advisory services, where we give as a swing trading opportunities for a short-term period of time. But here we give buy only recommendation. There is one newsletter also, Flash News Investment. Weekly, you will get each copy on Thursday. So this is Flash News. We have portfolio advisory PAS also, and our flagship product, which is DSIJ Magazine also. There are multiple screeners also available on our website, right from profit compounder screener to volume buzzer screener, sector mode companies. Basically, it will help you to understand companies which have moat in a particular sector. Turnaround company screener, you basically click and you will get the complete result. And you can easily download it in Excel sheet, and you can even copy it. So it will give you complete idea where the stock has moved in 1 month, price to book value, PE, ROE, EBITDA margins, turnaround company. There are multiple other screeners over here, EBITDA asset growth champions. And like I said, we post a lot of knowledge articles and a lot of articles which gives you an insight about the market. You can see it on our website. And I've already shown you the services and magazine, which is our flagship product. So the recent issue has come out. You can check it out if you are interested. So I hope everyone would like to visit our website. Links have been posted, and you can join our Instagram channel, YouTube channel. On Instagram, we are posting very good stories, trending stories, which are giving knowledge to our followers. So this was all from my side. Thank you everyone for joining in and spending your time with us. I hope I did justice to your time and you have learned something very interesting. Thank you everyone.